Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi, everyone, and welcome to episode 34 of the Capital Mind podcast. First up, apologies. We're really sorry for the long delay between episodes, but we've had a crazy few months. I came down with COVID, and mercifully, it wasn't too bad. And in between, we looked at the stock markets every now and then, and they seem to have decided that gravity doesn't exist anymore. So that's been keeping us busy as well. So now, as we start 2021, we're aiming to put all this craziness behind us to the extent we can, and for us to be more regular and systematic with these podcasts. So we're aiming for twice a month, and let's hope that works out. Now, we have a topic today that's honestly, it's been the subject of armchair debates and discussions for probably decades now, or something to that effect. On one hand, you have people who are interested in the safety and predictability of fixed deposits and swear by them. On the other hand, you have the others who talk about the higher returns and tax efficiency of, I guess, pretty much everything else, like stocks, mutual funds, and the like, and they swear by that. And often there's really nothing to bridge the gap between these folks. But as we start 2021, I feel the armchair debate has taken on a very, very real tenor, and suddenly the stakes are much higher. Because as we look at our inflation and we look at our interest rates, suddenly things don't look so rosy anymore when it comes to fixed deposits. And Deepak, you've mentioned in the past that fixed deposits are the biggest or one of the biggest financial assets in India, right? So I thought that this is probably what we should tackle today. So first, Deepak, welcome.
Thanks, Shray, and good to start the podcast again. And it's exciting to be here at the end of 2020.
Yeah, absolutely. So now, Deepak, I'll start with this excerpt from Raghuram Rajan this is Jan 2016 in a Walk the Talk interview at Davos. I think this was the start of all that DOSA economics thing, but we won't go down that path. But here's what he said. Look, earlier, you used to get some 9% interest on your fixed deposit, whenever this earlier was. But inflation was like 10 or 11%. So honestly, you weren't doing all that well. In, I guess, Jan 2016, he said, look, now you get only 5.5% on your fixed deposit, but inflation is 4% or something like that. So you're actually in a much better place because you're making some real interest, some real return on your money, and you should be happier, even though you're only optically poorer, you're actually doing better. Well, as you know now, we have this great article by our analyst Krishna out, and we'll link to it, in many places, the article and the presentation. The fixed deposits aren't really returning all that much. It's like sub 5%. And when you look at inflation, it seems to be 5% or higher. So, this seems to be a problem, right? How have we gone from having the interest rates working in the right direction to suddenly things not being so happy anymore?
This is Shray. I think this is now a problem that not just people in India are facing, it's also people all over the world, is that the governments and the central banks of the day have changed their track. They've actually gone down to the level of saying, we do not think that you can get a lot of money from relatively low risk instruments. So you give the governments money, and that's the safest form of investing your money by buying a government bond. We're going to make that as unattractive as possible. There's a single reason for that is when you had a recession of that kind you had in 2008, 2009, or perhaps what you're having in COVID today. The issue is that there's not enough risk taking and everybody's covering in fear, and they want to go to the least risk asset possible. So worldwide, the governments have decided that, our central banks and the governments together have decided that they want to give you as low a risk, a low incentive to be risk free as possible. In the West, that means going to zero rates, perhaps negative interest rates. That reflects into things like, government bonds are yielding almost nothing, and European banks are charging their customers to keep their money in the bank. Instead, they're telling go to risky assets, perhaps stocks, perhaps real estate, perhaps anything, run a business, but use that and that will improve the economy. This has its merits. In India, a similar function has started to appear in the sense the RBI has printed a lot of money. RBI has traditionally been very, very hawkish. They've said, listen, we're afraid of inflation. We're afraid of prices going up. But now they've said, listen, whatever happens, prices may go up a little bit. I don't care. I am going to try and build growth in, because growth is suffering and suffering a lot because of what is happening with COVID and other reasons. So I would rather keep interest rates and prices low. Now the interest rates haven't gone down so much; they're still 3.5%, 4%, but rates on because they've made money so easily available to the banking system, banks have said we'll cut our rates because we don't really want your money. We don't have any great avenues to deploy them in at high rates, so we'll reduce our deposit rates, we'll reduce the FD rates. um, Inflation remains relatively high because of food, but take food away and inflation is still around the 4.5% range. So what you're getting now is a much lower rate because governments are trying to push people into risky assets, and India is kind of falling into the same kind of curve.
Well, earlier the fights between these two groups used to be that, I mean, the stock market folks and the sophisticated investors would fight with the FD types. Now, what you're basically saying at some level, I know this is a bit of an exaggeration, is everyone is out to get your fixed deposit. No one particularly wants you to keep it. And they're making it as unattractive as possible.
Yeah, as much as that said, you have people who are simply unable to get credit on one side, and you have people who are giving you credit at these ridiculously low rates. It's almost like the haves and the have-nots. The bridge between them has gone to some crazy extremes, right?
Well, I think it's a little more nuanced than that, as you just said, because just as we were sitting to record this, it flashed on the screen that EPF is going to be at 8.5% for this financial year. In an environment of 5% inflation, that seems astonishingly good, right? Additionally, you've yourself mentioned that what were those instruments, PM, VVY, and so on, are still looking respectable. So, what's the deal here? I mean, let's say, my FDs aren't looking all that great. So, what do I do now? Who is the government still looking out for in this situation?
Yeah, this is actually interesting from two perspectives. So where you are right now and where you're going to be in the future. Now let's look at things as anybody who's, let's say, you're looking at keeping a certain amount of money aside for your parents, or if you're retiring yourself, you've decided you need a certain amount of money to survive. And that money, I don't want to eat out of the money I already have. So let it earn that. We're to a large extent a set of people who like a salary that comes in every month, and so we want our money to pay as a salary every month in a way. And that salary should just about take care of the expenses that we have. So let's say your expenses were 50,000 a month, and if you put in something in a fixed deposit, that's what your view was, that you will get enough to make that 50,000 a month. Today, because interest rates have fallen to 4.5 or 5% on an FD, you're sitting there saying, listen, if I do 5% on an FD, I have to put 1.1 crores or something like that into an FD just to make that 50,000 rupees a month. This is where I'll say, listen, there are better avenues, as safe or perhaps even safer than FDs, that give a higher return. And there are reasons why I'll come to that. But we've talked about this in that post. We've said, listen, you do a Pradhan Mantri Vay Vandana Yojana, which is PMVVY, operated through LIC. It gives you roughly 7.6% annually.
Wow.
Yeah, but it's limited to I think 15 lakhs per person. So if you have both of your parents as senior citizens, and it applies only to senior citizens, that they both get 15 lakh limit. So you can get 30 lakhs into it. 30 lakhs at 7.5% roughly is what, about 2.2 or 2.3 lakhs per year, which is roughly 20,000 rupees a month. So that's like almost saying government guarantees you 7.5% of interest at that or about those rates. Then there's something called a senior citizen savings scheme operated through the public sector banks. You have again 15 lakh per person, for two people is 30, only available to senior citizens. 7.4% roughly is the interest rate. So here again, you've got a semi-government, quasi-government guarantee to the whole thing, and you get 7.4. All this is taxable. So, but I'm trying to tell you here also from a tax perspective, you don't actually have taxation when your only income is up to 5 lakhs. So you don't have to pay any tax at all.
And that's per person as well,
Per
right?
person.
Yeah.
So if your parents are spending a lakh a month, you could generate 12 lakhs of income for them, 6 lakhs per person, without having to deal with any taxation whatsoever.
Yeah, because you also get some exemptions and stuff like that.
There's an
So
ATC
yeah.
exemption. You can put some money here and there, and you get some exemptions on fixed deposit. I mean, so on savings bank interest and so on. So there's a bunch of exemptions you can avail. So that about 6 to 6.5 lakh rupees per year is not taxed at all
Per person.
per
Yeah.
person. So effectively, it means 1 lakh a month for a family of two that's above 60 has no tax. So therefore, the highest return you could get in a cash flow instrument. When I say cash flow instrument, it's like, if I invest in a stock, even if it goes up 10%, there's no cash flow to me until I actually sell it. So that's not a cash flow instrument. A fixed deposit or cash flow instrument saying whether I like it or not, it's going to pay me that money. The same thing with this PMVVY and SCSS is they pay you cash flow whether you like them or not, like it or not. So you're going to have to pay a tax on that cash flow whether you like it or not. So you, according to me, it's like you compartmentalize and say my first 30 lakhs or 15, however number of people there are above 60 should go into PMVVY. The next 15 or 30 lakhs should go into senior citizen savings scheme. And now we come to what happens afterwards. Now, I'm not going to compromise on safety. I want it to be as safe as possible. What's the next best return I can get for the highest safety available? And there is an RBI bond, an RBI floating rate bond. You can only buy this from banks, unfortunately. I wish there was an online site. India is really backward sometimes in those ways that they create these fantastic products and then you have to go to banks to buy them, which is such a mess. But the RBI floating rate bonds actually pay 7.15 today. They're floating in the sense they float along with the national savings certificate rates. So the national savings certificate rate is 6.8%. You get that plus 25 or 35, I think. So 35 basis points. So 0.35% more. You get 7.15 right now. When they reset the rates of the NSC, you'll
go up
see
or
a
down,
change.
probably
You'll go,
down,
yeah,
but
mostly
anyway,
down,
yeah.
most likely. But and what happens over here is that 7.15 is quasi guaranteed because it's from the RBI. I don't think they can print money. So
I mean, when
they're
that
not-
happens, you'll have others. If the RBI defaults, you have other stuff to worry
yeah,
about.
I
Right?
mean, it's going to be least of your worries. So it's as safe as it gets. So when you're saying safe to fixed deposits, I don't know why then anybody would go to a fixed deposit because you have these other fantastic avenues. The first 60 lakhs, 30 to 60 lakhs you can do in those PMVVY and SCSS. Subsequently, any amount, there's no limit to the amount as far as I know, is that you can go to RBI bonds for. When you do this, you should have taken care of your cash flow needs. That means since this is the highest interest rate possible, if you put 1.5 crores into these instruments, you can generate 1.5 into 7, it's about 10.5 lakhs or to 11 and a half lakhs of income every year. And with two people, such income is tax free. So it's almost like saying the first 10, 11 lakhs use instruments like these to generate. Now, why do I say this? Why do I say this, and why is it a problem? The answer to that is also that when you have these instruments, you have a lock-in in a way. So SCS is locked in for 5 years. Something else is locked in for 7, 10. When you're locked in, you don't have access to the base capital. But a lot of people for whom you're generating income, the income matters though more than the availability of the corpus, right? So you lock the corpus in. There is a penalty for taking some of that money out in various cases, but even that penalty is acceptable perhaps if the interest rate that you were receiving is higher. So if you've generated 1.5 crores, you should pretty much put it here and generate your 1 lakh a month as income. Now you might tell me, listen, Deepak, I've actually got much more than that. So the stuff that's beyond, it shouldn't go into fixed deposits because now any income that's generated is pointless to you. It's just getting taxed. You're already generating how much ever you need from the other.
In the most tax efficient way. So, and just to emphasize this point, I mean, what you've said is if there is a family of two over here and they're both senior citizens or above 60 at least, you can very tax efficiently with something to the tune of 1.5 crores generate 1 lakh a month, of course. And it's almost tax free. I think that's how we calculated it. So that's like, if I may say, what you can get done with basically no risk, or it's safer than your bank account, at least.
Absolutely. In fact, I see there are chances where people may not be a senior citizen. So someone who is recently widowed, who has children, who may not be able to work but has a corpus left behind by her husband, who therefore has maybe 1.5 to 2 crores, and that person needs, let's say, 1 lakh a month to live, they can still use RBI bonds
Got
at
it.
7.14, but they may not be able to use the senior citizen
Got it.
schemes.
Got it.
But still, this allows them to say, okay, we'll lock in this money, we'll guaranteed get this amount, and I can survive on that. Anything beyond, maybe that may require an extra amount to be earned. And this is also why you should have insurance to this extent that says, well, if I'm going to spend a lakh a month, then I have to have at least a 1.5 crores worth of insurance or assets at least worth that much. This ensures that at least that part of the system is taken care of. Now, what happens beyond this is you should either take risk, so that means you're reaching people who have now the ability to take that risk, or you can put the money into different kinds of instruments where you don't get cash flow. Now, there are many instruments where you don't get cash flow. One, the most risky would be investing in a business, where the cash flow may take about 5 or 6 years before it comes. You could invest in other people's businesses, which is in the stock market, in the equity fashion, and so on, where again, there may not be much cash flow, but it's a great long-term business to hold. You may also then invest in debt. Now, investing in debt through mutual funds has a layer of risk. We've seen one extreme risk in a Franklin, but we've also seen risk in terms of asset values going up and down. And today, the least risky of those mutual funds yields just about as much as a fixed deposit. That means 4.5. The most risky ones you don't even want to get into because they're most risky, and you're like, okay, I want to avoid those. So you might want to balance those by saying, listen, I'll take a little bit of equity, a little bit of debt. All of these should not generate cash flow for you, because the minute they do, they get taxed, and that's a waste of time for you. It's not usable. So clearly the government has also put us into a position where we have to take risks.
Yeah, because look, I really do wish to point this out, that it was one thing when your fixed deposit was, I mean, still getting you, say, at par with inflation at a low interest rate, you'd be fine, right? Because you're like, I don't understand all this stuff. So at least this will give me what I need and I'm okay with that. But now you're saying that it's a guaranteed way of getting poorer pre-tax every year, post-tax perhaps even more so. And if you're like most Capital Mind listeners, I guess you have some assets to worry about, and so the taxes do matter. So it's almost reaching a state that other than them fulfilling some strategic or short-term purpose, as an asset class itself, they're just looking fairly not great. I mean,
Yeah, in fact, if you think about what the governments worldwide have done, they've actually increased asset prices at the expense of everything else, which means your stocks have gone up, but your employment, your job is not giving you a higher return every year. So you might actually not get a wage increase, but your asset prices are going up. That's because the companies that you're working for are generating higher profits by not paying you more, and their stock prices are going up. So investing in the company you work for is probably better than just working for that company in a way. But it's also that the focus on asset price inflation has basically become that, listen, we don't care if assets become a bubble. We don't care if you're overpaying for a lot of these assets. We just want to ensure that the economy continues. And in order for the economy to continue, the rich will get richer, the poor will also get richer.
or at least we hope so.
We hope so. Yeah. And perhaps this is their way of saying this is the least politically bad option.
Okay, well, I'm so glad you brought this up, because I have a problem with this thing. If what you're saying, for this to hold true, I have one issue with the current financial system in India. Why are my loans so expensive still? Because, I mean, and I think we can share without names. I mean, we have repeated distress from people who we've been dealing with. A person whose car is going to be possessed and we had to help them out just in time. Interest rates, people who landlords and other folks who've rented things, struggling to refinance and still paying 9-10% on, I guess, home loans, if that's the right word for it. I can see my FDs falling. Those other ones don't seem to be coming. The loans don't seem to be coming down at anywhere close to it, and that's a problem, right? Because
it is. In fact, I got approached for a loan a couple of days back. They said, I'll give you a loan against something," and then I said, "What's the cost?" And she said 9% fixed. Now, because I was familiar with this term, I said, "What do you mean fixed? And what does that actually mean?" No, it's a 1-year loan. So if you take a 1 lakh rupee loan, you pay 9,000. I said, "That's not what it is actually, because I'm paying you the loan every month back. So what does it effectively mean for me?" She said 16%. I said, "Are you out of your mind? Your deposits are down to 4.5, and you're charging me 16% for an asset-backed loan." So she's like, "Okay, that's what we have. We can cut it down to 15." But the interesting thing about this thing is that I am absolutely at the top end of the borrowing curve because I have no loans. In the sense of, if they looked back at my credit history, they would be like, okay, this guy can take loans. Of course he can. But even for a person like me, they're offering it at 16%. And the persons you talked about, the people who are taking or are asking you for money to be able to repay part of their car loans, they have the option of actually defaulting, telling the person, you take my car, and then going and buying a new car on a different loan, because
And there won't be red marks. I mean, there won't be like
well,
some.
unlikely to be any before this situation gets
So do
really
it
out
right
of
away
hand.
or something. Okay.
So you could you may be able to actually pull this off to some extent. Uh, uh, and the point about this is very simple. It's like the person is not doing this not because he'll get a red mark, but it's because he actually genuinely wants to pay back. And this person may be in a really bad spot. He will beg, borrow, steal.
Yes.
In fact, he won't steal. He'll just
Well,
beg and
yeah,
borrow,
beg and borrow, yeah.
before he and return that money. And we've seen this in another case where people got these apps which were charging usurious rates. Now we're telling them it's usurious, but they still want to pay back
Yes.
because they feel some kind of a moral obligation to. And I'm telling them, listen, you can default. This is not fair.
This is
It's
not real almost.
It's
I
not
mean,
even real. Yeah, I mean, you can't charge a person 4% a week. It's insane. So you have to default and come down to the negotiating table and say, I'll give you back my principal, but you guys are just taking us for a trip. And this is also not acceptable because they're like, we have a moral obligation to return loans. In that environment, why are banks not reducing rates? Because banks need to understand that people really do want to pay back and they're genuinely in unhappy. And banks have to take into account the fact that the RBI has cut rates just in order to help these people downstream. Banks, on the other hand, are saying, listen, we're not going to cut rates. Why? Because, well, why do we have to cut rates? If we fail, you'll rescue us at the outer extreme. If a person becomes an NPA and I have too many NPAs, anyway, you'll come and rescue me or do something like that. If I had to cut rates, that means they had to be competitive, somebody offering a lower
Shouldn't
rate.
there be someone coming in and offering you loans at a couple of percentage points lower and stealing all this business?
And look at the same car guy. If he has to do this, he goes to his bank and tells them, I'll repay my loan because I'm getting a better, lower cost loan as somebody else. The bank is going to put barriers to his exit. First, they're going to say, oh, well, you have to pay a 2% prepayment penalty. So, okay, fine, we'll pay the 2% prepayment. Oh, well, you'll get your papers after 3 months. At which case, the guy is like lost because the other bank's not going to wait for 3 months for papers. And according to me, this is where the RBI needs to really step in and say, listen, 24 hours. If a guy pays back, 24 hours you have to return the collateral as it is or it stands cancelled. In fact, I think India needs a better system. We've got UPI, we've got centralized banking. Why don't we have centralized collateral? If I have a housing loan, why should my papers sit with the bank? The papers are anyway meaningless because the registrar has the documentation of who's the owner of the property. The registrar also knows that you've taken a loan against the property. The bank can register at the registrar. It's electronically registered. You don't even need documentation. But assume you hold the primary documentation. If somebody else comes and offers a better rate to me, housing loans anyway cannot charge a prepayment penalty. I should have 24 hours to just click and move. The collateral can automatically move from one bank to the other. If a loan is paid 100% by depositing money into a certain account, the bank should be forced to close the loan instantly, which means the RBI guideline should be the minute the loan goes to zero, the loan is closed. You have 24 hours to return documents or start the process within a if the process is dynamic, if the person is willing to collect the documentation from wherever it is, or whatever time it takes you to post it, or if there's another lender involved, the process should start within 24 hours, okay, 48 hours, by the time after you've sent the loan in. Once you create this, every bank will compete. I'll tell you one thing. Let's say you're a person who's paid his home loan for, say, 4 years. And, okay, 5 years. 5 years out of 20. So you've paid in 25% of the loan, probably about 15 to 20% of your principal. The rest of it is interest and so on. So now you are actually a lower risk person to me because when you took the loan, it was a 1 crore loan. You paid 20 lakhs down. You took an 80 lakh rupee loan. And you paid 20% of that also. So it's about 64 lakhs, 63, 64 lakhs that's remaining on that loan. And you've got a house which is still worth, say, 1 crore because the housing prices haven't gone up. Now, me as a lender look at you and say, well, we have a much bigger buffer now. The house is worth 1 crore. It may fall to 80 lakhs. But his loan amount is only 64. So technically, I have a 36% buffer on the loan, on the value of the house. Why am I not coming to you as a bank and saying, listen, whatever interest rate it is that you're paying, I'll pay you 1%, I'll give you 1% less. If you're paying 8%, I'll give you 7. I can tell you this for a fact that a lot of people are paying 8, 9, 10% today also. And they find it daunting because every bank is saying, listen, we'll have to analyze this whole thing all over again. You need to pay 50,000 rupees as a upfront fee to do this. Why are banks doing this? Because this is clean business. I'm going to get a loan at 7%. My borrowing costs are down to 4% or 3%, in fact, in many banks. And I have endless supply of fixed deposits. There's RBI is printing money like there's no tomorrow. So why wouldn't I do this? Why wouldn't I offer a person 6% loans and 6.5%? Some people are, but they want new loans. They aren't going after the people who currently have loans.
The refinancing.
The refinance. And if you were able to refinance today, you could instantly reduce the interest cost of a lot of people. And I'm telling you, there is about 20 lakh crores in housing loans. If you reduced everybody's rate by 1%, that's 20,000 crores of savings you can put into people's pockets. And according to me, it's even more than that. You could reduce it by roughly 2% to 2.5% on loans. And you would get people saving on housing loans, on consumer durable loans, on car loans, all of whom are very tiny, by the way. I mean, the housing loan is the biggest of the mix. You've already done that to corporate because corporates are not stupid. Corporates are going to be like, listen.
I mean, they're aggressive. I mean, on this.
They're going to extract their part of the pie. Why aren't you doing it to regular people? Because if regular people, the retail public, gets a better cost loan or a lower cost loan, the chances are they're not going to default because of these moral obligation stuff, which we never factored into lending. The richest default.
Yeah, I was just going to mention that what you're saying doesn't, I mean, at least when you look at the news, the biggest defaults, and to some extent scams, but I guess that's a different thing. But the biggest defaults do seem to be done by the uber wealthy or at least the wealthy in a almost strategic or I don't care kind of manner. So.
Yes, in fact, I think the point over here is that the more money you have, the more education you have, the more likely it is you know the loopholes of the system. You know that the bank will have to take a haircut and it's willing to at some level. So you default. The poorest guy, even if he doesn't have anything, he's actually afraid of the consequences of a default, does not want because everybody has their dignity, right? So even the smallest, poorest person who has nothing has his dignity or her dignity. They're not going to want that dignity to be tarnished because that's all they have. It's a greater percentage of what they have than their money. So for them, even if they had to borrow at a very usurious rate, they would want to return their loans. This is why farmers commit suicides, despite the fact that farmers get waivers. The point is that people feel that they have to. In this context, we simply don't have the financial system, and RBI should be promoting hundreds of banks like this. Go in and break the monopoly of the large banks. Why is Bank A the primary lender for everything? It makes no sense whatsoever. I should have, today new banks that have come in.
So you mentioned that IDFC, in this case, here we can name, is trying to raise CASA, right? And is giving you 7% or something on your...
Yes, on the deposit. Why is it that an IDFC is offering you 7% when every other bank is actually reducing their interest rates? And what is it that IDFC can do with its CASA? IDFC is probably seeing the picture and saying, guys, you're not reducing your loan rate. So I can compete with you at your loan rates and I can offer my customers 7%. And I'll still be okay. You, on the other hand, all the other banks are saying, listen, fine, nobody's going to trust IDFC anymore.
But I was just going to come there. Isn't there a problem with the customers as well? I mean, the narrative we've formed so far is about how banks are not behaving particularly well. But customers also will put the incremental savings with a bigger bank and trust them and take the loan because, again, it's from the bigger bank. So there is a bit of an issue there as well.
There is actually. And some of it is unnatural. So, for instance, to some of the housing loan companies, they still say you have to come to our branch to close a loan. Why do I have to go to our branch? It's again a barrier to exit. I want to electronically close. I'll just give you the money. Just give me back my documents. Do I need to visit your branch and stand in line in a COVID time frame to just pay you back the money that I owe you. You should be coming to my house and taking the money, right? But no, they force you to, and they won't allow you to close a loan at the last 5 days of a month. They get away with this in the largest home lender in the country just because they have four letters to their name that have shaped Indian finance. We should not allow this shit to happen. I mean, I'm sorry for using the wrong language, but we are a society which has promoted ego over brilliance, and perhaps authority over responsibility. So when I say that, I mean it. I mean, a person who seems to have authority is more right than a person who has demonstrated responsibility, which is really sad, because in this case, we the reason why banks are allowed to get away with this behavior is because the largest banks are doing it. If it was a small bank that was doing it and the largest bank opposed it, you could bet your last rupee that the RBI would definitely come and hit the bank strongly, right? So if the RBI says, listen, 24 hours, no branch visits, the minute you've reached zero balance in your account, the bank is forced to close the loan and make it zero, and has to return any collateral to you within, or at least start the process of returning it within 24 hours. Make collateral electronic, where you could even have a centralized electronic system for collateral, where all liens are communicated to the respective regulatory authorities. So you could have shares under collateral, you could have real estate under collateral. It's a simple system where once you've paid your loan, that flag of saying this thing has a loan against it is gone. So if you did that, you would change the fact that people, and what this would do is actually make interest rates more viable. So it's like, if I have money, I can only get 4.5%. If I want money, I have to pay 16%. That spread needs to come down, and developed economies in every place, the reason why you pay low for, say, today, juice is not, there were times when the only juices you would get were Coke and Thumbs Up and Pepsi. Today, if you go to a supermarket, there are at least 40 different. There's some Indian coconut water, there's something else, there's something. And the point about this is, the more brands you have, the more competition you have, the different price points you can get different things at, and therefore inflation actually comes down. Uh, this also applies to the financial system. The more choices you have of finance, the more different varying interest rate choices perhaps, and more competition you have in this space, the better it is for the financial system. When the US reduced rates, mortgage rates came down almost instantly. That's because there's enough mortgage lenders in competition that say, listen, if you're giving a higher rate, I will help this guy refinance at a lower rate instantly. RBI has some rules also against this. In fact, they say, okay, listen, if there is a cost to roll over a loan, the person should pay the cost. You can't roll it into the new loan. Got it. I'm like, why? I mean, if it costs 50,000 rupees, I'll just give him a 50,000 rupee more loan. Let him refinance it. What's the big deal? You anyway going to come back hard on me in terms of any grievances or anything. Don't work with one edge case where some genius somewhere at the end of the
was
country
able to boost up the loan thing by refinancing.
Yeah, I mean, for that edge case, why do you come and hurt the entire system? And we authority over responsibility. It's just that.
I think it's an interesting place you've taken this. So I have two questions now to sort of, as we near the end of the discussion. The first is to, hopefully this is not going to last forever. So this sounds like there is an investment opportunity here, right? I mean, as a capital customer, like as you look at the landscape today, you see the madness of the stock markets, which may not be madness in your words. Then you see the fixed deposit and interest rates reflecting the government's position and the RBI's money printing. You see a bit of a disconnect with how loans are still not working out the way they should. So as you look ahead, this makes it look like as some things are still yet to correct, there is scope, not just in the stock markets, of course, which we talk about, but there's scope even in the world of debt and interest rates where there's money to be made. What's your take there?
No, I know very much. In fact, if you think about it, from the 1980s, when there was a recession in the US, the early 80s, which is when Volcker came in and increased interest rates. Since then, the coming out of that recession, we've had falling interest rates for the most part. And then Greenspan came in and he kind of reduced interest rates more and so on. The way the governments of the world have decided they will fight recessionary trends is to cut interest rates down to make people take more risk. And India will also have to go down that route. At some point, if there is no world's widespread inflation, and that's a caveat, India will see rates coming down. Now, think about what impacts our inflation. To a certain extent, we've financed ourselves, our country itself, through some part of domestic supply and some part of international supply that's imported. For the first time in many years, I think in the longest time I've seen it, we've had 2 or 3 quarters of continuous current account surpluses. Now, India is not a current account surplus country. India imports everything, crude, gold, all sorts of things. Despite all of that, we have a current account surplus in the last quarter, which was $15 billion. Earlier used to have a current account deficit, means we'd import stuff, we would, and then that would be financed by FPI, FII, so foreign investors. So capital account would be surplus, current account would be a deficit, they would match, and RBI's purchase or sales of the dollar would make up for this whole thing. That's called the balance of accounts. And typically what happens is, if you don't have enough inflows, then the rupee depreciates. When the rupee depreciates, your imported goods cost more and inflation goes up, and therefore so now the question is, now take this whole thing and map it for years forward. India is a small country relatively to its to the world market in terms of economic power, but very big in terms of size, population, and all that stuff. As we come out of this and grow into this, we will attract more and more foreign capital. Also, because the foreigners have printed so much of their own currencies that they want to invest anywhere where there's yield, and India has yield, and India is going to get more foreign inflows just as a consequence of that. If things continue like this, we will not import inflation. We will have foreign inflows coming in as investment, as capital. Our current account surplus, which currently is probably more due to the government stopping imports at ports, even if it were to. But if you think about it a little bit more, if stopping imports at ports or slowing them down a little bit has caused us to go into a current account surplus, that means we're not really a mega deficit country. We're at the borderline of these things. So it's possible that because of this borderline thing and capital flows coming in, the rupee is likely to perhaps appreciate but not depreciate too much. The 4% average depreciation we have seen on a yearly basis since 2000 will probably go down to 1.5-2%. The difference in inflation between India and the rest of the world is probably also going to narrow down to 1 or 2% only. If the world inflates at 1%, 1.5%, we'll inflate at 2.5, 3.5% in general. This also means that interest rates in India are not likely to go up tremendously. Also, the factors which I told you about, which is more competition. I think I scream my head off about it, but there are people trying to make this change, as in lend to people with security, without security, against shares, against property, all of these things at lower and lower interest rates. Eventually, they will succeed and bring down lending rates and bring down further borrowing rates, which also means that people who are borrowing at a high cost today, some of them who are actually good, will be able to borrow at a much lower rate tomorrow. Yields will fall. So it may be useful to park money into risky assets, assuming that this will happen eventually, which means the most risky would be, say, starting a business, because you may not need cash flow now. Because now you already parked your required cash flow into the RBI thing and all that, but you have when you start a business, your first 3 years you don't have any cash flow, you'll get cash flow eventually. Or you invest in other people's businesses. Other people's business would be in the stock market, in the private market, or however you like it. But the idea is that you don't need the cash flow, you want the appreciation of the business as it grows up. Both these factors actually help GDP eventually, because if more people were to do this, for instance, if you support someone who's been able to buy a car to survive, he might eventually get to a point where he can buy 2 cars, and then that would employ more people, get more business going, and so on. So this is 2 ways. The third way is to find debt that is currently priced at a very rich level. Now, at some point, it may be a government debt itself, because government is paying 3% for a 6-month loan, but 6.5% for a 30-year loan. 6.5% is a lot. It's higher than inflation. Even if we looked at 5% inflation, 6.5% is something that you can buy today, and tomorrow, if interest rates were to come down, that 6.5% will result in profit to you of maybe 10.5, 11%, simply because people tomorrow start expecting lower rates. So the opportunity from an investor standpoint is in the risk, not outside of it. So you could, so
So you are taking a risk. You are betting on the interest rate cycle. You're hoping that there's no mass inflation event worldwide and that there's no government default and so on. But there are opportunities there, in particular on debt that's still not adjusted to what you've said, the likelihood of falling interest rates.
And I think what you should be careful here is that a high risk bet is different from when it's credit risk. I mean, it's like there are some companies where I know they might actually fail. Taking a risk on that is very different from taking a risk on a government bond that is 20 years ahead of me, because I know the government won't go down. Well, maybe they will, but that's just
I mean,
a
again,
tale I don't care about.
too many variables change in that
In that equation. But let's say that I was taking a bet between the two. I think I would take that bet that there are some companies that will survive and that are more quite likely to survive. But they currently aren't getting as much love from the markets as they otherwise will. So the companies that lend against gold, which for the most part has been a relatively safe asset. So even if you have extreme inflation, that gold price will continue to remain high. So those kind of companies may offer you a 9% return today. So that might actually be your opportunity where you say, okay, I'm going to get 9% if this company just remains where it is. If things get better, the yields of that company will fall from 9% to 7%, in which case my investment of 100 will become 120, because that's the way interest rates work. So you end up with a much higher gain on your money than otherwise. So these opportunities, I think, also exist in the fact that while rates are down, the reason for those rates coming down has not reached a point where the rates can go down no further in India. In the West, I would be afraid of taking this
Yes,
stance.
got
In
it.
India, I think lots of scope still applies.
Remains okay. So now I'll end with actually a parting question, which is a little different from how we started, but still tying it together. Look, I do get your point with FDs not looking that attractive anymore. If you're in the business of wanting to have a corpus and wanted to give you some capital, you've mentioned the ways you can do that. Sorry, some income. You've mentioned the ways in which you can do that. But as you know, if FDs are the most beloved financial product, and they seem to be, I think you've argued about this with people as well. It's not just, if I may say, retired people with a bunch of money putting their money in FDs, right? It's even people who are saving money every year. I mean, everyone from, say, household workers to executives at IT companies to well-paid startup founders and all. Even they were probably parking some of their money in FDs. And that doesn't make sense either. So if you were to sort of make a more generalized, recommendation or bit of, I don't want to use the word advice given how loaded it is, but if you were to make a more generalized comment on, in this universe, when the FDs are just making you poorer, uh, what do you do with your money if you don't need to generate income from it?
I think clearly the answer is find a way to take a little more risk or move into a cash flow situation, move a cash flow product like an FD into a product like a mutual fund, which may give you the same return, but it's not cash flow based. So I'll tell you, earning 4.5% from a debt mutual fund in the growth mode is better than earning 4.5% from an FD when you don't need the money. So when you don't need the money, you're getting the money, paying tax on it, and then reinvesting only whatever's on top of it, which means it's a complete waste of money. It's just paying the government tax for no reason at all. Whereas if you invested in the mutual fund and you got the same 4.5, okay, let's say you got 4.4 also, that's effectively better than moving your money into anything else. In fact, if you looked at paying tax and you were just afraid of the cash flow, you could get a tax-free bond, a bond from a public sector company that's actually tax-free. These were issued in 2010 to 2015. These bonds actually pay about 4.4% so far, and it's tax-free. So effectively, you would not pay tax on that return, but you can use that money. It's only 4.5%. But this is the range of instruments that you would actually invest in that said, listen, I don't want the cash flow, but I want relative safety. So a government bond fund may be safe depending on how long your investment with them is, and what kind of bonds they buy. So you want to analyze that. The next set would be, listen, if everybody is taking risks, then maybe the risky assets are safer than we think. Because if you think about it, the West doesn't allow its stock markets to go down.
Well, yeah, interesting way to put it, but
Yes.
I do
As
see your
in,
point.
yes.
Yeah.
I mean, why don't they do it? It's not because they love stock markets. They have forced their citizens to put their money and their 401ks and their retirement funds into stocks. If you let stock markets fall a lot, now you're jeopardizing people's retirements, which is not what you set out to do in the first place. But you don't want the political damage of that to hurt you. So the governments of the world unite to ensure that their stock markets don't fall because it's a political problem. And India will go down the same route at some point in time if everybody were to invest in equities. So you're actually probably safer investing in equities, give or take the 30% fall you'll see once in a while, which will be this V curve on the outside, than in debt, right? Because it doesn't matter what the valuations are, because they just don't want the markets to fall from whatever level they're at. So the old normals, the old norms don't apply. uh, because earlier it used to be one set of people who are bullish and one set of people who are bearish. Now it's one set of people plus the government who's bullish. And you're fighting the wrong battle if you're not bullish, right? So you're at this point, it might make sense to say, listen, when I'm betting, I understand I have this problem with risk, but if I look upon it, the political situation is that risk exists in not taking risk.
So the thing is, I completely understand what you're saying. It feels innately wrong to me in many levels. And I think that's the best way to end 2020, right? With nothing making sense anymore. And saying, surely this can't be right. But we'll
But
see.
it is, and they're slapping you on the face with it, right? So being in cash is the worst thing you can do right now. So maybe interestingly, things will change over the next few years. I hope I'm still able to say this or laugh at myself 3 years down the line. But I have a feeling it's going to get even more inexplicable than before, and we'll all be muddled up even more because we come from a school anchored to the principles of a past that no longer applies.
Yeah. Well, on that note, Deepak, let's end 2020 and start 2021. And let's see how this podcast ages in about every year for the next 3 or 4 years.
Yes. Happy New Year, everyone, and thanks for listening.
Chalo, thanks for listening. Bye bye.